Welcome to Integrated Insights with ICCG. For more than 30 years, our team has partnered with small business owners to prepare for and navigate the business transaction process. Pull up a chair as we share stories and insights from our experience on all sides of the M&A table. Welcome to another episode of Integrated Insights. My name is Michael. I'll be your host today. I have the co-founders of ICCG here with me today, Grant and Dave. Today, we're going to be talking about deal structure. So to get started, what are the different types of deal structure?
Yeah, that's really difficult question to answer very simply, but just to overgeneralize, a lot of times there's a stock purchase or an entity purchase, like you're buying the actual shares of the company, and then on other times there are the purchase of assets, meaning the actual workings inside of that entity. And so we generally refer to those two as a stock purchase or an asset purchase.
And just to clarify, the asset is not just buying the machines; it's buying all the assets, like accounts receivable. It's all that. It's like you said, it's the workings of the company.
And beyond that, the structure can include, the time and the extent of the proceeds. So you could roll some ownership over to the new company. You can wait to get the proceeds because there's an earnout. In other words, there's a contingent proceed on some sort of performance metric. So if sales remain at this level, then we'll give you another $1 million in a year or whatever it is. And so the structure is it's a little oversimplistic to say there's just two types and you just get to choose two options. There are multiple nuances to it.
Can you give just a simple example of how structure can affect the outcome of a deal?
Yeah, I mean, there's obviously tax consequences, right? So if you sell stock in a corporation, you generally get capital gain treatment. If you sell assets out of a corporation, or if you sell an LLC, which it doesn't matter whether you sell shares or assets in an LLC, it's basically treated as an asset sale. Then you don't get capital gain treatment on any or on most of the proceeds unless there is a pass-through entity involved where there's goodwill. So all that to say, there's higher tax consequences in some structures than others, and you have to plan for that. But there are other consequences too, because if you buy the assets of a company, then a lot of times it doesn't come along with the licensing or the contracts or those kinds of things. And so you're tempted to buy the actual entity itself because then you get to a lot of times assume all those things. And then, the third real big bucket is that that if you buy the entity, you assume all the liabilities of that business, where in an asset purchase, you generally don't assume any of the liabilities existing in the business.
Okay, so you ended there talking about some of the liabilities, and that's kind of some of the downsides. Can you focus a little bit more? What are the advantages of buying the corporation or the entity?
Well, years ago, Dave and I were in an industry that had municipal contracts, and it's very difficult to gain a municipal contract unless you are the incumbent. The city or county that you work for, the state that you work for, is very slow to change. And so when we went and we bought some of those businesses, a lot of times we were very tempted to buy the actual entity itself because it came along with the designation or the contract that went along with that municipality. And so that's the biggest one. Dave, do you remember any other time where we've been tempted?
Well, there are times where we can't quite get the net's not quite working out, the net, which I know we'll get to in a little bit. But and I think that we've just been able to go, and there was such a tax advantage to us selling the S corp, for instance, or the stock, that we were just really open with the buyers coming out of the gate, saying, "Look, you're going to get a little bit better price on this, but it's going to be it may not be the advantage, but the price may be an advantage to you."
Yeah. Yeah. I mean, if the buyer is more agnostic about whether they are buying shares or stock than buying assets, a lot of times we see that in Texas because you've got out-of-state companies that want to be in Texas, but they need some sort of base, a Texas corporation anyway, to operate in Texas, and a lot of times there's an advantage when you're seeking contracts, especially where we've been around for 30 years. It's a lot easier to get a contract than saying, "Oh yeah, we're a brand new corporation," and then you got to explain you're a survivor or you're assuming the contracts, and it's more difficult. I say all that. It just depends on everybody's priorities, and we always know what the buyer is wanting to do and what the seller is wanting to do, and the idea is to marry them, and the option is to change the structure in order to make it palatable to both parties.
We had one deal specifically where we had 3 different locations of the same type of industry, and they were new coming into Texas. It was just like you said, they needed an established entity. So they bought the entity for one of the locations, and then they used that entity to buy the assets of the other 2 locations, which was kind of the best of both worlds for them. And I think for the sellers in this case, it ended up being a pretty good thing.
And that was what you would commonly call a regulated industry. And so that's why that licensing is super important. That's why the length of existence or the time that those companies have been in existence, it didn't matter on the second 2 purchases. It really mattered that they had one that ended up being, okay, it's been around for a while, and it's established, and so they bought the stock of the one and then the assets of the other.
And there's also some outlier reasons for, I guess you wouldn't do it for this reason, but there are some advantages. Grant, you would know a little bit more about this than I would, but some of the modifiers on the employment tax or the unemployment tax and things like that, the modifiers are what am I looking for? Workers' comp and things like that. If the company's been around for a while and they've got good modifiers, that's another reason, because they're not having to start over with that modifier.
Yeah, and the unemployment tax as well. I mean, it does, the rate varies tremendously. There in the old days, there was some advantages to buying a stock of a company that had a net operating loss carry forward. So there's some tax considerations. But anymore, we're coming across companies. Michael, you and I were dealing with one the other day where there's retained earnings in that corporation, C corp retained earnings, and so at some point, okay, so that guy sells the assets of the corporation. He takes out all the cash, but he's got retained earnings inside the company, and in order to dissolve the company, he has to pay tax on the dividend of the retained earnings that he takes out. So all that to say, it's not just the tax on the proceeds of the sale of the assets that you have to deal with, but when you dissolve that corporation because you're done with it, there's more tax to be paid. So I sound like the tax is a major consideration, but it's part of the consideration.
Yeah.
Right.
Yeah.
And Michael, this is why Grant and I have been business partners for so long, because I don't have to know all that stuff. He does. And so I let him memorize all that. But that honestly, that's the advantage to having someone who understands tax law and tax accounting at the table.
The deal that he's talking about, where we sold the stock of one that then bought the assets of the other 2, we were representing all 3 entities. That that was not just a knowledge of tax law or knowledge of the rules, but that's a sitting around a conference table and Dave throwing out creative solutions to the other problems that existed with regards to licensing or whatever. And then collectively, our team comes up with a possible solution. And we see that time and time again. And that's why, we put a huge emphasis on the structuring of a deal, because it has to maneuver through everybody's expectations that are sitting at the table. And quite honestly, Dave and I love those conversations because we all get to throw in our 2 cents, and nothing's a dumb suggestion. We won't say nothing is a dumb suggestion, but we try to think creatively out of the box, and not all of the people that typically serve our clients are capable of playing the what ifs.
That's great. And I think what you guys just kind of went through there in the back and forth was it really helped to show the variation that you can see, right? That every deal is really different, and there's different solutions for every problem and multiple solutions to every problem. And like you said, Dave, it really highlights the fact of having someone that has that tax accounting background, like we do at ICCG. One thing, just to kind of sum it up and to go back to kind of the high level points that you made, is basically what you're saying. So assets, like you might get a lower price, you're getting the equipment that you need, you're getting what you need to run the business, but and you're not assuming the risk of the entity. But what you're giving up by not going for the entity instead is you're giving up potential relationships and established business and some of those things that would be really helpful in kind of immediate success. Does that sum it up pretty well?
I think it's an overgeneralization, and that's really why you said, which is correct, every deal is different, because the goals and anticipated value that the buyer has are very different every single time. And so the seller needs to meet the expectations of the buyer as much as the buyer needs to meet the expectations of the seller. And that's where you structure it accordingly. Because to some buyers, it's always a stock purchase, particularly when you're talking about foreign buyers. European buyers, they're looking at stock purchases. And when you're dealing with strategic buyers, they've already got their company, they're already established, they're coming in to buy another place. They don't want your liabilities. They're probably going to limit their offer to unless there's contracts involved that they really care to keep in play, and they don't feel like they can assume those contracts or licensing, they can generally do an asset purchase.
Yeah, and one thing I just want to kind of double click a little bit on what you just said, Michael, was that kind of that blanket statement, if it's an asset purchase, it's going to be less, it's a lesser price. Not always. I mean, the sales price oftentimes is with the sales price, but it's the net. And we didn't cover that. And we've covered that a lot in some of our other podcasts. But really, at the end of the day, someone can sell, we've sold companies for less, but it was a stock purchase. So the net was actually more. And again, that's just, is that correct?
Yeah.
I mean, that would,
yeah.
And it doesn't always work like that. But, sometimes that would be a win-win for both sides. And, again, it's just different. It's kind of the different, we've talked about the different types of intermediaries, and I don't want to put everyone in the same bucket or whatever, but there are a lot of, people out there who are trained just to broker a deal and basically find a buyer and turn it over to the attorneys and walk away and go to the next one. And that's just a very, very different job than what we would do as intermediaries. We're going to walk with them, help them structure. We really want, we want their next business 20 more years down the road when they sell their next business.
Yeah, and I think the one item we haven't spoken about, or the influencer on the structure of a business, is the lender of the buyer. So a lot of times the bank is going to prohibit maybe a stock purchase, or is going to not have, especially now that SBA programs are, all over the place. I mean, there's huge SBA limits now. And so, those larger, $5 million loans that you see coming out of the SBA, a lot of them don't like certain things. They don't like the real estate outside of that entity, or they don't want you to buy stock. They want you to buy assets. And so and again, banks have their preferences. And so you're kind of constrained by your lender.
So on that note, when you guys are talking about all the different options with a client, a seller or a buyer, whatever side, do you have all that kind of lender knowledge up front for the most part? Or is that something where it's like, hey, we're going to have to come up with a few different options because we know some of these are going to be determined by whether or not we can get financing?
Yeah, if we're on the buyer side, we certainly know. But when we're looking for buyers, for our clients that are on the sell side, we're constantly asking the buyer to make sure that the particular structure that they're proposing in the LOI is approved by their financing source. I think we have look, we've been around a lot of banks. And so there's some that we just know that don't like certain deals. And so we'll double click on it. But we're never going to assume that a bank is not going to change their mind.
Has it ever happened where an option was determined, or a client was looking for a specific type of situation, but then the buyers that came to the table, the potential buyers that came to the table, maybe, no one was the perfect fit. So that option had to change or shift a little bit to maybe switch to a different buyer that was the closest fit?
Again, our assignment a lot of times includes several priorities from the seller. And one of those priorities is that the buyer meets the net goal or expectation of the seller gets what he wants, basically. There are other things. I mean, I just got off the phone today with a potential buyer of one of our clients, and culturally, they're just an incredible fit. Now, there's another buyer at the table that's not quite culturally fit. So you want to see, okay, how much does that extra $1 million mean to your client, right? Because he says culture is really important, but what happens if the guy that is not a culture fit is going to pay you an extra couple $1 million? Well, then, maybe you don't worry about culture as much. So, but we're always trying to meet all of the expectations, not just the net, but that's table stakes to the other kinds of preferences that the seller has.
Well, rewinding a little bit, talking about the advantages and that kind of thing. So, why do buyers a lot of times want to buy the assets?
Well, the biggest reason is so they can write it off. Because if you buy stock, you're not depreciating assets. But if you buy the assets, then you are going to pay less taxes because you're writing off the asset purchase that you made. But perhaps the biggest legal reason is that there's not the assumption of the liabilities of the corporation, and so there is an exception, and it's a big one. And I would say it has a lot more teeth in Texas, but we spoke recently about a similar situation in another state. In fact, Dave and I were on the phone yesterday talking about it. But typically sales tax or state tax is some state taxes, but in Texas, we have just sales tax. It goes with the assets. And so if you buy a business and they have they've either misreported their sales tax, we see this a lot in the construction industry, or they just haven't filed their sales tax. We saw that in a service business recently as well. then if you buy that business or the assets, you think, oh, the liabilities don't transfer. Yes, they do for the sales tax, and so you inherit that and have to pay it. And then, of course, the indemnification in your asset purchase agreement allows you to go after the seller. But by that time, the seller is in the Bahamas.
Yeah.
That's why you better do your diligence before.
That's right.
Yeah.
So if buyers often want to buy the assets, how do you get them? If you have a client that's wanting to sell the corporation and that's their strategy that they're going for, how do you, I know we already talked about contracts and relationships and stuff like that. Is that the angle that you take to get them to buy the corporation, or is there a different strategy?
We use waterboarding.
Okay.
No.
Yeah. All right. Moving on. Next question.
No, look, I mean, this is the art, right? It's helping the buyer see the value in doing it your way. And then, obviously the value to the seller to change is that you're finding a willing buyer that's a good match. But it is an art. I mean, but you got to know what you're talking about, because a lot of people draw really dark lines and they won't move. We've just gone through, there's so many variables and so many pluses and minuses. What you got to do is mitigate for the minuses and make sure that you get more pluses than minuses, right? I'll just say this, and this is so important for business owners to understand. This is why you don't want to just have a bean counter, because it's more than dollars. It's more than a simple formula. I'm going to pay you $10 million for your business, and then you go away into the sunset. There is so much more to it, and structure is a huge part of that, but only because of the other things that are involved. I mean, there are employment contracts, there's leases on real estate, there's structuring all of those things. We're dealing with one deal right now where the lease is way over market. And so how do you mitigate that from a buyer's perspective? You're going into buying a business, you're going to assume the lease because you want to have an office out of, but the rent is 2x what market is. So what does that do to the purchase price? How can we get around this really high rent and not penalize both the buyer or the seller?
So we probably have some listeners, just before we wrap up, I'm sure we have some listeners that are listening to this episode and thinking like, man, I have more questions than answers right now. Like, I hear what you guys are saying. I hear that there's a ton of different structure options and a ton of different situations when approaching a deal. But I still don't really know what's the best structure to approach when I want to do a deal. So, and some of those same business owners, some of those same listeners might also be thinking, hey, I'm years out from a sale. Why would they need to come and talk to us now? Why would they come sit down at the table with ICCG?
Because structure is everything, and that's just going to make their life easier. So some people think they know what they're doing. They run great businesses. They're super smart about what they do. But when it comes down to this, we find that, hey, if you've never done it before, it looks like we can't go run their business like they do, but we can sure help them structure a sale. And so if they get ahead of this, there's lots of tax reasons for that. They might need to change from a C Corp to an S Corp. That in itself is a 5-year process. And so there's reasons to do that. And a lot of times it's just taking the initiative, letting down the pride a little bit and saying, I don't this isn't something I know. But if you want to maximize the sale, if you're a business owner and you want to maximize the sale of your company, I would highly recommend you sit down with someone who knows what they're talking about. Just, it's a free consult for us.
Michael, I've got a spaghetti diagram on my whiteboard in my office because this guy didn't come see us 5 years ago, and we're trying to get around almost an impossible tax situation. And if Dave and I have had one, crazy recurring conversation with business owners, it's, man, I wish you'd come to see us a few years ago. And so we have this tagline at ICCG, come sit at our table. We don't charge by the hour. We want to help people. And a lot of times we can't help them as much as we could have if they came to and sat at our table a few years before.
That's great. So yeah, anyone that's listening that thinks, hey, I think I might want to sit down with ICCG, the best way to do that, our email is in our show notes. Just shoot us an email and we'll send you an NDA so that we can talk about that, get a couple of years financials from you, and then schedule a meeting. So we'd love to do that. Like Dave said, it's a free consult for us. So that's at no cost to you. So that's all the time we have for today. Grant, Dave, thanks for sitting down with me. And that wraps up another episode of Integrated Insights with ICCG. Be sure to subscribe and stay tuned for more stories from our team. We love hearing from our listeners. If you have any questions or topics you'd like us to cover, please send us an email in the show notes. For more information about ICCG, please check us out on our website or follow us on LinkedIn and YouTube. Until next time, there's always a seat at our table.